This is the Value Investor Podcast with Tracy Reinick. All things value, all the time.
Welcome back, value investors. So here we are just 1 week later after I said stocks probably hadn't bottomed and they might continue to fall. And so sure enough, here they are. So my advice from last week still stays the same. Don't try and time the bottom. No one will get it right. And even if you're dollar cost averaging in, you'll still make money if you're a long-term investor. So what should you be looking to buy? As I mentioned last week, nothing wrong with the indexes. They are down further than a week ago, but you may want to look at that again. And also, if you're looking just at individual stocks, look for the companies with the strong balance sheets. Look for those at the top of their industries, not the ones that are struggling. Now is not the time for those with shaky management. So if they had problems, in the C-suite, if the CEO was fired and they're doing a search, or if the company's in a turnaround in some way, if they have same restaurant sales or same store sales that were already flat or negative going into this, well, this isn't going to make it any better. It's going to make it a lot worse. So go for the ones that had the double-digit same-store sales growth. Sure, this quarter and probably next quarter, those are going to be, flat to negative as well. But the chance of a rebound there with the companies that already have good things going on is much more likely. So I thought I'd take a look at some screens today to kind of see what was happening with the stocks. Now, the Zacks rank is going to be really messed up here going forward because there's going to be cuts to earnings estimates all over the place. And a lot of the analysts just aren't doing it yet unless the company comes out themselves and gives some kind of guidance. But no company right now is giving any guidance. They basically are all saying, we have no idea one day to the next, or even 1 hour to the next, and we're withdrawing our guidance. It's, that's gone. And so the analysts are basically sitting on the sidelines too, waiting to see how this all shakes out. But we know there's going to be huge cuts here. So the rank is going to get real iffy here with a lot of 4s and 5s. And I don't know how many ones are going to be in there. We always have about 219 ones, but we'll see going forward how that's going to look. So I thought I would screen for good management. We actually have a screen for this. It's called Management Excellence. And what it looks for is the main component is a low debt to equity ratio, which means it's under 1. And the debt to equity ratio, which most people don't really use it that often, but what it is, it divides the company's total liabilities by shareholder equity. And if it's under the 1, it means that there's a lower risk. So for instance, tech and service firms, those kind of companies will have lower debt to equity ratios because they're really not taking out huge amount of debt for things like big manufacturing facilities, things for production because they're a tech and a service company. So if they're selling to the cloud, it's a lot less debt intensive than if they're a railroad and they have to actually go out there and buy, the engines and all that stuff and fix the rails all the time. So you're going to get a preponderance of the tech and service companies in this kind of screen, which is kind of what did come through the screen, actually. So when I ran this, and I don't think it had the Zacks rank in there because the rank isn't really vital for what this screen is looking for. But this one did have the debt to equity ratio under 1 plus a few other components. And it gave me just 23 companies. So I picked out 5 that were kind of interesting and took a little bit closer look to see kind of what the stocks were doing, if they're cheap, and where things stand. So let's just go over some of those. And then I have a few more ideas that you might want to consider if you're looking around for your wish list and for stocks to buy now that there's been this big pullback. Okay, so the first company out the gate is Applied Materials. AMAT is the ticker there. They have a debt to equity ratio of just 0.5. Those shares are down now 39% year to date. PE is 10.8, so a little bit cheaper. Some people might want to get this even cheaper than what it is right here, but it is significantly off the highs here, and we're going to be finding out more about what's going on in this sector shortly, as some of them are going to be reporting imminently, actually. So the Applied Materials, AMAT, keep that one on your list. Okay, Garmin is number 2. GRMN is the ticker. They have a debt to equity ratio of just 0.01. So like basically nothing. PE is 16. So it has gotten cheaper. It's down 30% year to date. And Garmin is, they're in a whole bunch of industries. Some of these could definitely be hit here: aviation, marine, outdoor, fitness, and auto. And they were just in the early February going to recommend a dividend be paid out starting in June. But now I don't know if that's still on the table, but they had the cash flows to easily pay that. So that's something to watch here. A lot of companies either suspending or cutting dividends right now in order to preserve cash. But Garmin, GRMN. Then the third one is one I've talked about before, and I'm kind of shocked it came up on this list, actually. INMD, that's INM as in Mary, D as in David is the ticker. They only went IPO last year in 2019. They have a $475 million market cap, so very small cap. And these shares have basically retraced back all the way to the IPO price after being up quite hugely. So they definitely are on sale here. PE is just 8. And if you remember what InMode does, they have a device that helps you look better if you're taking pictures on Instagram. So they are kind of in the beauty area. I would say beauty gadgets for like clinics, for doctors to use. It uses like radio waves to make you look more attractive. Now, if we're in a recession, things are rough the next couple of months, you can't leave your house, whatever's going to be happening, you may not be able to get out and go have this procedure done. But a year from now, 2 years from now, I think we're all still going to want to look good for Instagram or whatever other social media site we may be on by then. And so good to keep this one also on your list too. Okay, and then switching to the fourth one, I'm turning the page here. Microsoft showed up on here, ticker MSFT. If you don't already know it, I own this in my own personal portfolio. I only added it last year, and it's basically back to right around where I added it, maybe a little bit below. Its low for 2019 is around $100. And right now it's at 138 when I recorded this. PE is still pretty pricey at 26 times, but debt to equity ratio is just 0.64. We know about all the cash they have. They own LinkedIn. They have the Xbox. They're very diverse with the cloud business. Plus, I'm recording this on like their recording app that's on my laptop. So yeah, they're basically everywhere. That's why the stock is holding up a little better than some of the others, because everyone knows they're not going anywhere, even if this is a severe slowdown. So, but if you're looking for some safety, Microsoft may be the place to be, MSFT. And then our fifth stock is Synaptics, SYNA. And on their website, they tag themselves Human Interface Solutions. And they do a lot of those touch display kind of technologies. Now, these shares aren't anywhere back to 2019 lows even yet. They were at lows in 2019 and then saw a big rally here, down 26% year to date though. So they are off the highs like everything is. Debt to equity ratio is 0.69 and the PE is just 10. So I would maybe put this one on my wish list and start watching it to see if I could get it a little bit cheaper. But some of these big tech stocks that have had just like huge runs, while they have sold off, aren't back to any kind of real true value areas yet. So those are the five that showed up in the screen. But then I also wanted to look at a couple of my other favorite areas, just to kind of see what's happening with some of those, because I have been priced out of them for several years in some of these. And one of my favorite areas is the railroads. So I took a look. Union Pacific, that's my favorite out of all the major railroads. UNP is the ticker there. It's down 41% year to date. The PE is finally back in value PE land of 14 times. The railroads have been trading over 20 for several years here. And they actually, earnings and revenue expected to be up, earnings up double digits because they've gotten way more efficient. They've managed to cut a lot of costs, and even with volumes declining. But what's going to happen now? If we go into a quick recession, that's going to affect volumes, revenue. But when we come out of it, and there's a lot of demand, as we've heard already from Federal Express, it's seeing record load factors on its deliveries out of China to the rest of Asia because they've been on lockdown for a couple months. Now everything's ramped up again, and now they're getting out their products. Same thing will happen here in the United States. So there will be pent-up demand, and the railroads will come back. So keep that in mind. I also like Union Pacific because it's domestic U.S., and it's got those big facilities along the Mexico border, but they got to be getting hit a little bit from anything coming through the port of Los Angeles there, because we know that the shipments are way down right now from China. So it's a mixed bag, but if you can get it on sale, take a look. And my other favorite railroad is Kansas City Southern. KSU is the ticker. They're down 36%. PE is now 15. They have rails in Mexico. So I've always liked them for that reason. But if things get a little more dubious, it could get a little bit difficult to get maybe some of that, those shipments up through into the U.S. I don't know that for sure, but that is a risk there. If like the border were to close completely right now, they're closing the border with Canada, the U.S. Canada, but not to cargo shipments. But that could increase costs and have other impacts. So keep that in mind with Kansas City Southern. But I like both the railroads. I like all the railroads, actually. So take a look at that group. And one other group you might want to take a look at, because it's getting completely hammered, are the fertilizers. Now, they were getting hammered going into this. It's been a rough couple of years for the farmers. Then we had the bad weather last year on top of the roughness with the trade war and everything else. And so these shares were already weak, but they've just been completely slammed here. So a couple of the ones I like, they don't have good Zacks ranks. They're like 4s and 5s right now, which are the cells and strong cells. But Nutrien is one of them, NTR. They are in Canada, and they do all the phosphates and the nitrogen. And they also are big on the farming side on the seeds. So they have like an agribusiness, as I like to call it. It's down 49% year to date. PE is now 11 on Nutrien. So might want to keep that on the list. Mosaic is the other one, MOS. I currently own this in the Insider Trader because the insiders did buy, seems like forever ago, but I want to say it was last week only, after their stock is now down. Now it is 68%, but they were buying when it was down about 50%. It's sunk even further. PE is at 24.9, however, as that E, the earnings is going to fall a bit here. The stock is under $7 here. It was right around $20 before this huge sell-off began. So that's another one you might want to look at for just value, because it's just been really sold off. And one thing to know about the fertilizers, Hubei province in China, the epicenter of the coronavirus there, is the largest producer of the phosphates fertilizers. And so they were on lockdown for 6-7 weeks. And that meant other suppliers had to supply it, essentially. And it really tightened global inventories while they were on lockdown. So things aren't awful for the fertilizers here. The prices have rebounded. There is demand, and hopefully we're getting, at least so far, a decent spring here in the Midwest heartland, and fertilizer will be purchased. So keep that in mind when you're looking at some of these companies, but everything right now is just getting sold off. So, there are a lot of opportunities. This only covered a few things that are going on out there, but I'll be bringing you all that I can every week as this continues and as we seek out value. It will be helpful to listen to any earnings conference calls that are coming in areas that you are following, because the companies are saying very interesting things on the calls, and you can really see that they don't really know what's going on either. So everybody's in the dark right now. Don't feel bad. And if you don't feel like buying anything right now, don't feel like shamed into like you must buy something here. It's a once in a lifetime opportunity. Well, you have to feel comfortable with your own situation. But I'm looking around myself. I haven't dove in my own personal accounts yet, but I'm keeping very close eye on my wish list, and some things are looking pretty interesting. As I said in the beginning, you won't be able to time the bottom, so don't think you have to. If you're a long-term investor, if you're thinking 10, 20 years from now, and you're buying good quality companies, those companies will see their earnings rise again in the future. So that's what you're buying. You're buying good companies and their ability to grow. So let's recap the tickers again. We had Applied Materials, AMAT. We had Garmin, GRMN. We had InMode, that's that small little beauty company, INMD. We had Microsoft, MSFT, Synaptics, SYNA. We had the railroads, Union Pacific, UNP, and Kansas City Southern, KSU. We had the fertilizers, Nutrien, NTR, and Mosaic, MOS. And as always, be sure to subscribe so you don't miss a single episode. You can get us on Apple Podcasts and on Spotify, and you can get us on SoundCloud 2-for-1 with The Market Edge. I'm bringing all the podcasts even as we're working from home or in lockdown. So I'm trying to get better sound quality for us, and we're working on it with my production guys. So hopefully we'll have something a little bit better next week as we all are working through this very unprecedented times. But be sure to check out my Twitter feed. I'll be tweeting out a lot on the earnings calls and anything else stock related on there. So you can get it on StockTwits. You can get it under my name at Tracy Reineck on both StockTwits and on Twitter. But be sure to get all this information somewhere. And I'll see you again next week with some more value stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.